what was important and what the market sensed was that he didn't say something. He had earlier this year started saying that we are in no rush to lower interest rates, referring to the Federal Open Market Committee. And at Jackson Hole on Friday, he did not say we are in no rush to lower interest rates. He basically said, well, maybe we're ready to make some adjustments here. And the market heard that as Fed put is coming. And what was interesting is he also didn't mention that, oh, by the way, between now and the September 16th, 17th meeting, there'll be more economic indicators. And those indicators are very important. There'll be two inflation indicators and payroll employment, and they might change everybody's mind about what the Fed should do next.
Yeah, I mean, I think he suggested that maybe the labor dynamic of this economy is taking a little bit of precedence for the Fed vis-a-vis inflation. But boy, you can't discount inflation perking up because we had more tariffs announced today with the furniture. So how do you think about inflation?
Well, he himself said that tariff effects on inflation can be sort of a one-shot deal. Said the problem is if the tariff implementation isn't one shot and kind of gets spread over time, that could continue to create some inflationary pressures. I think what also is missing in the discussion here, and he didn't discuss it, is that there's some indications that services inflation, maybe if it's not heating up, it's certainly not cooling off. I think what tariffs have done, if they've stalled the progress on getting down to 2%, and now we're kind of stalled at 3% because durable goods inflation has come up, and that's clearly an indication of the tariffs.
Ed, one of the great triumphs of the Yardeni, and folks, I linked this with the great technical analyst Ralph Acampora, is the belief in revenue growth in earnings. I mentioned nominal GDP, the animal spirit of the nation, Ed Yardeni, more at Jackson Hole than I have in 18, 20 years before. If we get an elevated nominal GDP through real growth or inflation, for a stock market, does it really matter which is pushing nominal GDP up? We just go, don't we?
Right. Yeah, revenues are revenues. The PE times E is done in nominal terms, and the E is in nominal terms. So that's correct. We look at revenues, and then we look at earnings, and the implication is profit margins. And what we see in the data is that the first and second quarter earnings were remarkably strong, much stronger than expected. There usually is a positive earnings surprise, but it was particularly strong in both quarters. And now, during the second quarter, we have earnings on the S&P 500 at an all-time record high. No wonder the stock market is at an all-time record high. Of course, it helps that the valuation multiple is elevated at 22. But I'm thinking the bull market continues here on earnings, and I think that earnings will continue to push stock prices higher.
Bottle that, folks, and whether you agree or disagree with Ed Yardeni, go to the beginning of that conversation where he's agnostic on why we have buoyant nominal GDP. This is sacrilege in the modern days, Paul, and I'm sorry, Dr. Yardeni is correct. Nominal gets everything going.
That's right.
Ed, so we did have pretty strong earnings here. How do you think about, are earnings strong enough to support this market going forward?
Well, I think so. Here's my arithmetic on that. I think by year end we could get to 6,600 on the S&P 500. That's not that far off, and I think we can get to 7,700 by the end of next year. And my assumption is that by the end of this year, when we're thinking about what earnings could be next year, we'll be looking at analysts talking about $300 per share. And then at the end of next year, I think they'll be talking about $350 per share. Multiply those by the current 22 multiple and valuation multiple, and you get 6,600 and 7,700.